Thinking about renovating your kitchen? You're not alone. Kitchen remodel is one of the most popular home upgrades. But how do you pay for it? Should you tap into your home's equity? And if so, what's better, a home equity loan, a home equity line of credit, or a cash out refinance? Let's break it down. Kitchens aren't cheap. Even a basic facelift can run you well over $20,000. And if you're dreaming big with new cabinets, new appliances, maybe knocking down a wall or two, you're easily looking at six figures, well over $100,000. So using your home's equity smartly could be a game changer if you pick the right way to borrow. First up, home equity line of credit, or HELOC. This is just a fancy way of saying second mortgage. Second mortgage means that it's in a second or subordinate lien position to your first mortgage. So basically when you go to pay it off, they get paid after the first lien holder. This makes the loan more risky to the lender and therefore carries a higher interest rate than your first mortgage. In order to keep the rate competitive, HELOCs usually have variable or adjustable rates, which means the rate and your payment are subject to change. Now, HELOC is basically a giant credit card attached to your home. You get a credit limit, say $100,000, and you can borrow what you need when you need it. The pros? Flexibility. You only pay interest on what you owe. And because of that, they usually have lower starting payments. The cons? The interest rate can change. And here's the kicker. They usually compound interest daily. Daily compounding means every single day, whatever you owe gets a little bigger if you don't pay it down fast. It's sneaky, like that late night snack that seems harmless, but adds up real quick. Now let's take a second to talk about why compounding matters so much. Home equity loans usually start off with interest-only payments, so the balance of the loan will not decrease unless you pay more than the minimum payment. Now, if interest compounds daily, you're paying interest every day on the total balance, even if you pay the balance off at the end of the month. This is unlike a credit card that usually doesn't charge the interest if you pay the balance off at the end of the month. This can seriously jack up the real cost of the loan over time if you're not aggressive about paying the balance down. Next up, home equity loans. Again, a second mortgage. Like a HELOC, but you get one lump sum at a fixed rate, and it's going to be a higher rate than your first mortgage since it's a second lien. The pros? You know exactly what your payment is every month. This makes monthly budgeting easy since your payment won't change. The cons? Well, you pay interest on the full amount right away, even if you don't need all the cash right away. Although the rate is fixed, the math behind the scenes isn't super friendly if you let it drag out over time. All right, now, cash out refinance. This is where you replace your old mortgage with a new higher mortgage, and you pocket the difference in cash. So for example, if you owe $200,000, you might refinance into a $275,000 loan and walk away with $75,000 in your pocket, minus any closing costs like an appraisal. The pros? One payment, usually a fixed rate, and most importantly, the rate is lower than a second mortgage because it's in a first lien position. The cons? Well, if you take out a new 30-year loan, you're resetting your mortgage term. And if today's rates are a lot higher than what you already have, it might not feel great. But if your current rate isn't crazy low, or if you're already thinking about refinancing anyway to debt consolidation or other home improvements, it can be the smartest move, especially since it avoids having two separate payments for your home. Now you can take out a term for less than 30 years on a cash out refinance, but the payment will be higher. I usually recommend taking out the longer term to keep the payment lower and paying extra if and when you can, since first mortgages typically have no prepayment penalty. All right, let's recap. HELOCs are flexible but usually have daily compounding and variable rates. Home equity loans are predictable with fixed payments, but you have to take all the cash at once and pay interest immediately. And of course, the rates are higher than first mortgages. Cash out refinance gives you lower rates, one fixed payment instead of two each month, but you lose the current rate on your current loan. Bottom line, it's not just about the rate. You see, it's about you, your budget, and your goals. Everyone's situation is different, so you need to make a game plan. If you want help figuring out your game plan for your kitchen and your wallet, shoot me a message. I'll run the numbers for you side by side. Or reach out to us on our website and schedule a no-obligation call at www.mytownmortgage.com. Thanks and have a great day.